Hey everybody, it's Matt. I received an email from a vendor recently that was talking about merger arbitrage as an investment strategy and how to talk to clients about it. And it's serving as inspiration for me to put together a series of videos that just talks about some of the alternative investment strategies that I would like to implement for clients and I think are good diversifiers for portfolios. And just kind of help explain what some of these super esoteric, what I'll refer to as hedge fund style strategies are and how we use them, why we use them, all that good stuff. So let's get into it. Okay. First of all, my clients and any of you that have been watching my YouTube channel or listening to podcasts or reading my blogs or whatever kind of media content I'm putting out there may be aware that I think a modern investment portfolio might have a collection of stocks as well as bonds, which are the traditional investment portfolio components, as well as another bucket that I call alternatives, and my industry refers to as alternatives. And essentially, this is a catch all bucket. So it can be almost anything. Some common examples that you've probably heard of: private equity, private credit, investing in art, investing in collectibles, commodities, gold, hedge funds. Some of these are catch-all buckets in and of themselves. So, for example, collectibles. What might we collect? Well, I would love to collect as many guitars as is humanly possible that I think may accrue value over time or pass them down to my heirs. Other people may collect coins or cars or stamps or really the world is your oyster. You could collect beanie babies or something like that. Commodities is a catch-all for things like energy resources, oil, natural gas, gasoline, maybe things you find on a farm like corn and soybeans, or things you find on a ranch like hogs or cattle, precious metals, industrial metals that are used in production. Um, and so hedge funds in and of themselves, this is another catch-all category. So if you think about this like a Russian nesting doll, we've gone from the outermost shell alternatives into these smaller different shells that each have their own subcategories. And what we're focusing on today is within the categories of hedge funds. Okay, so within hedge funds, some examples are there are strategies that are involved in macro, which I'll talk about later. All of these I'm going to talk about later. Market neutral hedge funds, managed future strategies, style premia strategies, multi asset strategies, arbitrage strategies, and diving deeper into the nesting doll. Under arbitrage, you might find things like merger arbitrage, convertible arbitrage, event driven arbitrage. What this video is going to focus on is merger arbitrage. This is the thing that the vendor happened to send out to me, and it happens to align with a fund I'm using from a separate vendor. And I just am going to use it as a starting point to start explaining what I'm suggesting we invest in the alternatives landscape. So let's move on to some of the PDFs. Okay, so this is the PDF that the vendor sent out to me, and I think it's kind of amusing. It's teaching advisors how to talk to clients about merger arbitrage. Um, so the reality is, you may have experienced this in discussions with financial advisors. Is many financial advisors are very good at selling and talking to clients, maybe not as up to speed on actual investment strategies and markets and things like that. My first career, that was about 14 years long, was where I worked for the asset managers that created investment portfolios, and I would go educate and market our investment portfolios to advisors. So I would be the guy going around to large, nationally known institutions, to those financial advisors, and talking to their advisors about our investment strategies. So I would walk in with this PDF and begin to explain to advisors what is merger arbitrage and why do their clients need it. And our the asset managers I work for might have anywhere between 90 to over 100 plus investment strategies that all do different types of things. So this is kind of my wheelhouse from my older career. But it's just amusing because it's telling the advisor what is merger arbitrage in plain English, why it may make sense, and so you're just getting a look behind the scenes in terms of how advisors even learn about this. So many of my attorneys would probably be familiar with this concept. Two companies announce that they are going to combine in some way. And then there is a period of time for which we're not totally sure that the deal is going to close, that everything is going to go as smoothly as they may have announced, or that we might hope. And so there can be low returns that are driven out of essentially investing, betting on how the deal closes, whether it closes, so on and so forth. So you could pause if you want, but there's strategies for cash deals, there's strategy for stock deals, but basically there is some risk premium in the public markets associated with whether this deal is going to close or not. And so it says, well, why might this make sense for clients? Why would clients care to invest in the risk exposure of announced deals coming through? And the answer is diversification. This chart is only showing correlations between merger arbitrage and different types of bonds, so US Treasury bonds and US corporate bonds. But note that the correlations are relatively low, low meaning somewhere between +1 and -1. Close to zero is basically not correlated. This strategy serves as a good diversification tool against bonds, as evidenced here, but also against stocks, which doesn't happen to be in this guide because their investment product ties merger arbitrage to bonds. But if you were to go look at a similar chart for stocks, it would be fairly similar. And so what they're touting is low correlation. As always, if Warren Buffett has ever said anything positive about an investment strategy, then the people that do the marketing have to include that because everyone loves Warren Buffett. But the point is, it's a low correlation strategy. It helps diversify an investment portfolio. It's not meant to be a grand slam, shoot the lights out, have huge double digit returns all the time. It's meant to be a relatively low volatility, low risk strategy, and correspondingly low return. But the fact that it is that low return is largely not correlated with other assets in your portfolio is what makes it attractive as a component of your investment portfolio. So I'm going to flip over to ChatGPT and I'm going to ask it to explain merger arbitrage in plain English as it relates to what's going on in the markets right now. Okay, so the prompt I'm going to give ChatGPT is just please explain merger arbitrage in very plain English using the current Warner Brothers Netflix deal as an example. So I'm recording this on Wednesday, December 10th, and if you've been following news, financial media recently, you know that Netflix and Warner Brothers have announced that they've struck a deal in which Netflix would take over Warner Brothers. And Hollywood is going nuts over this, concerned about legacy film, legacy media, that sort of stuff. And so, even more recently, there has been a hostile takeover bid from Paramount saying, hey, Warner Brothers, forget about Netflix. We will pay more to take you over. And they're going directly to Warner Brothers uh, shareholders to propose this. So, shareholders have the right to vote on whether they want to accept the higher price Paramount deal or stick with the Netflix deal. And I think this is a really salient example of what merger arbitrage is because Netflix and Warner may have announced a value for their deal, and investors could have positioned themselves to try and make money on it one way or the other via arbitrage. And then, of course, there's this new monkey wrench thrown into thing, which is a hostile takeover bid from Paramount at a higher price. And so this is a really great example of kind of merger arbitrage in live action. Um, and frankly, I'm doing ChatGPT because I think a lot of people trust it. I think it's really useful, and it's probably going to explain it better than I am. So we'll just go ahead and hit submit and wait for it to show up. Wow. Long. All right. Well, I'm going to pause it for a second, catch up on it, and come back. Okay. So, as expected, this is a really good synopsis and really great example, in my opinion. So, it goes through what merger arbitrage is. And, essentially, I think this is the best explanation. When a buyer offers to acquire the company, it usually is going to pay a premium for the company relative to the current value of the company. If you want to buy all of the outstanding shares of stock of a company in the market, you're going to drive the price of that stock up by doing so. You're gonna take up all of the available supply, and so the supply demand function means that you're going to pay over the current market price. However, the actual price of the stock usually doesn't jump to reflect that to the total offer price, and that's because there's all this regulatory risk that I think many of my attorney clients and listeners are familiar with. It makes intuitive sense. So what they talk about here is the Netflix Warner deal first. They're going to offer $27.75 per share. Netflix is to buy Warner. And although Warner's stock price jumped, it didn't go all the way to 27.75 according to ChatGPT, which I think is probably right. And what you might find is maybe the stock price jumps to say $25 per share. That spread, $2.75 between where the stock goes after the announcement and where the deal is expected to close, that is a spread for risk because maybe the deal doesn't close or doesn't close in the way that they announced it. And so merger arbitrage are the investors that are making a calculated bet on where they should buy the target stock, in this case Warner Brothers Discovery. Where should they buy the target stock that compensates them for the non-zero chance that the deal will go through? And so there's this, probability of whether the deal will close, and what's going to happen if the deal fails, and how much are you willing to risk as a result. Let's say you have a 80% chance of gaining $2.75 if you buy at 25 and it closes at 27.75, but you have a 20% chance that the stock's going to fall to 20 in the event the deal fails. There are hedge funds that this is what they do for a living. They take advantage of these types of trades and arbitrages and come up with calculated risks. And then it can be blown up by things like Paramount's hostile takeover bid, in which now there is this what was what do they say, a relatively clean bet on deal closing risk with the initial Warner Brothers Netflix deal announcement has now changed into potentially a bidding war. And so maybe a merger arbitrage fund bought Warner Brothers Discovery at $25 a share, thinking that it may close at 27.75. But now that Paramount has come out and offered much more than that, I forget whether it says, say, $28, $29 or more, um, now they really could have made a bunch of money. If any of these deals close and there is a bidding war, anyone who bought at 25 could really, really do well. And of course, if everything falls apart, they could do really, really poorly. But this is just a real time, great example, in my opinion, of what merger arbitrage is. It's a relatively obscure, esoteric type of strategy that offers usually low single digit returns. Um, but it's so typically non-correlated with broader stock and bond markets that it makes it a great addition to a portfolio because it can operate regardless of what's going on in the broader economy, the broader bond market, stock market, all that kind of stuff. Um, and so that's why somebody might include it in their portfolio. Okay, finally, where am I using merger arbitrage? Well, if we think about the overall investment portfolio, having had alternatives here, one of the funds that I use to capture alternatives exposure is this AQR Diversifying Strategies Fund. This is a single investment fund that offers a variety of underlying exposures. So the fund itself has a variety of underlying air quote hedge fund strategies that I talked about, I think over here. Yep. This list is me coming bringing it directly from the AQR fund. There's millions of different hedge fund strategies, not millions, but there's a wide variety of different hedge fund strategies. In order for me to come up with a succinct list, I'm just taking the ones that are featured within this particular AQR Diversifying Strategies funds. One of them is the Diversified Arbitrage Fund. And so going further into the nesting doll, the Diversified Arbitrage Fund is going to have exposure to merger arbitrage, which we went through, convertible arbitrage, and event driven. I'll do future videos on these other things as well as on the other types of hedge fund strategies. But this is just the initial video, like I said, that was inspired by the marketing collateral that a different asset manager sent out explaining merger arbitrage. And I think it's good for investors and listeners and everybody to understand what it is that we're touting, because often the media, the financial media, will talk about alternatives, and usually what you're hearing about are things like private equity and private credit. And my clients and listeners know that I actually don't love private equity and private credit. I think within the realm of alternatives, they're not that useful as diversifiers. I think these are more things that are easy to sell to retail investors. And so when I'm talking about alternatives, I'm getting further down the rabbit hole into more esoteric things, such as uh, merger arbitrage and all of these other types of strategies, these hedge fund strategies that you can see listed here. So hope that's useful. Go talk to ChatGPT about the Netflix and Warner Brothers Discovery merger if you want to learn more and hear some of the drama going on with that. But it's a very timely, great example of what merger arbitrage is and how people can take advantage of it in investment portfolios. Thanks. Bye.